when can you do it? This week or next week? This week, today and tomorrow, and Thursday is a POE day, isn't it?
Yes, sir.
So Thursday, no, most likely we won't meet. Well, you're at home on that day, eh?
Yes, sir.
So we'll choose a date on next week. That is 23rd, 24th, 25th, one of the days. You all can make a small presentation on the assignment that you all did. Please see that each and every member presents at least a small part.
Duration time?
Up to you.
Okay.
We have 2 hours time for a day, ne? So 5 presentations. Each one, even if you all take 5-10 minutes each, I think it will, like, time will fly like anything.
Yes.
So let me know when you are prepared to do it. Huh?
Okay, sir. Okay, sir.
Okay. So I think last week we spoke of about we have to speak on derivatives today. I think last week we stopped here, the currency swaps, isn't it? We spoke of forward exchange and swaps, currency swaps, and non-deliverable forward forex cross-currency swaps. And today we are going to discuss interstate swaps and then a few other derivatives that could be practiced. As I told you last week, the idea of discussing these new products, derivative products and other new things, which may essentially may not be available in Sri Lanka, but if you really go through the market, sometimes there would have been at least 1 or 2 or few transactions done through a few banks. The idea is that to give you the features and then how you could introduce new products to the market, because your qualification, the certificate which is given to you by the institute bankers will not be complete if you are not discuss the features, at least features of the derivative products. So just describing the features to enable you to think more and use a few features or combined from 2-3 products, and to come out with some sort of solution which could give you additional revenue as money brokers. The first place. Second place is that you could contribute to the development of the market. My experience with the regulator, the central bank, is that when there are some few new products and new mechanisms are being proposed, they always take it seriously and then look at the mechanisms, the pros and cons, And if you can convince them, they will really back you, because it is their job as well to introduce and upgrade the market. So therefore, those 2-3 derivative products that we discussed already, I explained the features of them, and very often how they could be used or utilized to the benefit of the banks and the customers. So money brokers, the professionals in the market, need to have the in-depth knowledge of these products, so that you can play that pivotal role expected out of you as money brokers in the market. So let's get on with the interstate swaps, IRS, interstate swaps. Because that day we finished the cross-currency swaps, you would have realized how simple it is, the mechanism. So similarly, interstate swaps are a little more complicated than those simple derivatives, but the fundamental model or the purpose, if you understand, you might be in a position to amend or change or little bit things here and there, and then introduce some products to the market. So let's go on. Interstate swaps. Two borrowers independently borrow equal principal amounts for the same period. In other words, when there are two entities or institutions or individuals in the marketplace, there's a David worked out example as well. You'll understand better. But describing the features, when there are two borrowers independently, they go to their bankers or lending institution, and then they borrow the principal amounts for the same period. One borrower agrees to pay the fixed rate loans and the floating rate loans. You are familiar with, I suppose. Fixed rate loans are that for a 2-year, 3-year, 4 or 5-year period, entire period, rate is fixed. The rate that the borrower has to pay the lender, the rate of interest is fixed. Then on the floating rate, the rate of interest that the borrower has to pay to the lender is floating, meaning the rate to be used is described as LIBOR plus 1%, or LIBOR plus 2%, or LIBOR plus 3%. London Interbank offer rate. LIBOR plus 2 or 3 or 4 or 5%. Now, in the case of Sri Lankan standards, most loans have been placed on a floating base or basis as 3 months weighted average treasury bill rate, or 6 months weighted average treasury bill auction. Because whatever the SLIBOR rate available in Sri Lanka, as I discussed some time back, is not practically used, more or less, because every morning the bankers are expected to submit their interbank offer rate for various periods to the central bank statistical department, and they compute the weighted average for each period and then announce SLIBOR. But in the case of 3 months, 6 months, or 1 year treasury bill rates, there are auctions, actual transactions taken place, and the weighted average rate are decided. So that is more or less a guiding light to the interest rate practical movements based on demand and supply. As you all know, last 5-6 weeks, we saw the treasury bill rate of the interest rate curve bottoming up, and 3 months, 6 months, and 1 year treasury bills and treasury bond rates curve started moving up. So likewise, the in Sri Lankan market for loan products, when they are say floating rate, it is more or less the weighted average treasury bill rates or AWPLR, average weighted prime lending rate of the banks. There again, the prime customers' lending rate are informed by the respective banks to the central bank, and they compute and inform, they compute a weighted average rate and inform or announce the AWPLR, average weighted prime lending rate. I guess these days it is 6% plus 6.5 or something like that AWPLR. So these are the two basic differences used in interest rate swaps. We take two borrowers, one person borrows fixed rate, other person borrows floating rate. And in the interest rate swap, a separate agreement between the two borrowers to share with each other based on the interest cost of each other. And the interest rate swap sometimes is nothing to do with the bank or the lending institution who lends the money to the two borrowers. So therefore, in effect, swapping the interest rate obligations and of the risk of interest rate changes. Again, let me summarize. The two entities who borrow money independently go to their own lender, bank or finance company, and borrow money. And these two lenders speak with each other, negotiate with each other for an IRS, interest rate swap. And in the process, they agree to exchange the interest payment streams with each other. And thereby, the customer who agreed to borrow from his banker, who agreed to borrow on a fixed rate from his banker, will end up paying floating rate. And the customer or borrower who agreed to pay floating rate to his lending institution, finally ending up paying fixed rate for the loan. And arithmetically, the advantage shared by the two borrowers effectively make their borrowing cost lower than even what they could have paid to the bank or the lending institution. As a worked out example, you can understand better. So in effect, swapping of interest obligations and of the risk of interest rate changes. Advantages: each borrower receives funds priced in the manner it wishes, fixed or floating. Meaning the first borrower who borrowed fixed on the bank might have thought that borrowing floating is the best for him, going by his asset and liability portfolios. And there are studies of understanding of the market. So, but however, he would have been best placed to borrow fixed from the bank, and the other borrower who borrowed floating from his lending institution might have thought borrowing fixed is better for him. Now, the fundamental difference between borrowing fixed and borrowing floating, you must understand this way. In a rising interest rate market, rising interest rate curve, at what rate you do prefer to borrow, fixed or floating? Please speak up. In a rising interest rate curve market, now say supposing these days in Sri Lankan rupee market, if any one of you to borrow for about 5 years, these few weeks we have seen the interest rate curve turning up. Would you be happy to borrow floating? If you at a floating rate, if you borrow floating rate with each and every treasury bill auction when quarter% higher, quarter% higher, quarter% higher, and AWPL are being higher quarter by the banks, you will have to pay higher rate, isn't it? So you would love to borrow fixed this period, because even if the rate goes up, the fixed agreed rate, you will be happy to pay for the future period. But when the interest rate curve is downwards, or when the interest rates are easing out, then the person who contracted to borrow at fixed rate is a disadvantage, isn't it? Because when the rate moves down, the floating rate, had he borrowed at floating rate, the subsequent payments, AWPLR or the treasury bill rate, weighted average treasury bill rate will be lower. So subsequent loan installments, interest cost will be lower. So this is the fundamental theory to decide on fixed rate or a floating rate. So each borrower pay interest as desired, lower than would otherwise be available by sharing the gain equally. So,
excuse me, sir.
Yes, please.
Sir, we can't see any presentation. You are showing a presentation?
Oh, I'm sorry. You should have told me. Okay.
I was late to join, sir.
Sorry about it. I thought you... Let me start again. Interstate swaps, there are two borrowers independently borrowing from their lenders, respective lenders, and speaking to each other, between the borrowers, they agree to swap the interest rate obligations. If the first borrower borrows at a fixed rate from his banker, and the other borrower borrows at a floating rate from his lending institution, they choose the lending rate or the borrowing rate going by the competitive advantage that they could borrow. So the first borrower who borrowed at fixed rate might wish that he could have borrowed floating, and the second borrower who borrowed floating might wish that he could have borrowed fixed, so that they would have been at advantage. So borrowing fixed is meaning is to hedge against the rising interest rate curve. Subsequently, loan installments at a rising interest rate market will be even if the interest rate goes up. If you have contracted to borrow at fixed rate, your borrowing cost remains same despite the interest rate moving up. Then the second borrower, his opinion would have been the interest rates are going to go down, so therefore might as well borrow floating. But he would have been quoted a better fixed rate loan to contract with, so he would have gone for the fixed rate. And now these two, borrower number 1 and borrower number 2, after having borrowed from their respective lenders, construct interest rate swap between among themselves and end up the first borrower paying floating instead of fixed, contracted with this lender, and the second borrower end up paying fixed instead of his loan contract with the lending institution to borrow floating. There is a workshop example later on. You can see how best the advantage could be shared between the two parties. Swapping of interest obligations and of the risk of interest rate changes is a very significant feature in this derivative product called interest rate swap. So advantages: each borrower receives funds priced in the manner it wishes, fixed or floating. Each borrower pay interest as desired, lower than would otherwise be available, by sharing the gain equally. Because both the borrowers choose to borrow at comparatively advantageous rate, and that advantage component is shared between the two. So that is going to give them a benefit of at least a few basis points on the rate that they pay interest on the borrowing. Why is it called interest rate swap? An interest rate swap occurs when two parties exchange or swap future interest payments based on a specified principal amount. So as we discussed, the actual cash borrowing is from their respective lenders, but between the two borrowers, they base the interest rate swap on a specified principal amount, maybe the amount that they borrowed each from their respective lenders, and that for the purpose of interest rate swap, that is becoming a notional principal. Among the primary reasons why financial institutions use interest rate swaps are to hedge against losses, manage credit risk, or speculate as well. Because in the developed financial markets, interest rate swaps, there are experts who trade the interest rate swaps and speculate on them when they can judge where the interest rate curves are heading, whether it is going up or whether it is going down. And therefore, it can be used for speculative purposes as well. Why are swaps used? In the case of companies, these derivatives or securities help limit or manage exposure to fluctuations in the interest rates or acquire a lower interest rate than a company would otherwise be able to obtain. I was explaining the comparative advantage component. So that's why it says they could afford to structure a lower interest rate than a company would otherwise be able to obtain. Swaps are often used because a domestic firm can usually receive better rates than a foreign firm. Now, in our market also, when a foreign company is there, bankers or the lending institutions might perceive a little higher risk because they are a alien company or a foreign company, and the rate quoted for their borrowing could be a little higher than the rate quoted to a local company. A swap is an agreement for a financial exchange in which one of the two parties promise to make with an established frequency a series of payments. Because as you know, when a loan amount is arranged or contracted, the repayment on an established frequency, maybe monthly, loan installments have to be made as series of payments in exchange for receiving another set of payments from the other party. As I said, when borrow fixed, he wishes to borrow floating, and then he would then structure the IRS with the other party to pay fixed and borrow floating. So one cancels the other, and then he switches in his interest stream of payments to floating rate. These flows normally respond to interest payments based on the nominal amount of the swap. Notional principal amount is the amount used in the swap, nominal amount of the swap. Plain vanilla interest rate swaps, businesses and individuals attempt to secure cost-effective loans, but the selected markets may not offer preferred loan solutions. For instance, an investor may get a cheaper loan in a floating rate market, but they prefer a fixed rate because it would have been a rising interest rate curve market. Interest rate swaps enable the investor to switch the cash flows as desired. Assume, this is an example. There are two people, Paul and Mary. Paul and Mary. Assume Paul prefers a fixed rate loan and has loans available at a floating rate, LIBOR plus 0.5%, or at a fixed rate at 10.75%. Mary prefers a floating rate loan because she thinks that the interest rate curve will be downwards, or interest rate in the future will go down. So therefore she prefers a floating rate loan and has loans available at floating rate of LIBOR plus 0.25% and a fixed rate of 10%. Now here, due to Mary's better credit rating, Mary has the advantage over Paul in both the floating rate market, where she can borrow at 0.25% better than Paul, and in the fixed rate market, 0.75% better, 10.75 against 10%. Her advantage is greater in the fixed rate market, so she picks up the fixed rate loan. Remember, but she prefer borrowing floating, but the comparative advantage is in the fixed rate market. So she picks the fixed rate loan. However, since she prefers the floating rate, she gets into a swap contract with a bank to pay LIBOR and receive a 10% fixed rate and receive 10% fixed rate. Now, this bank is not the original bank where she had contracted the loan, fixed rate at 10%. She contacts a Interstate Swap bank to pay LIBOR and receive a 10% fixed rate on the bank, on that Interstate Swap bank. Remember, now if she negotiated for a floating rate which she desired, her rate would have been LIBOR plus 0.25. But now she's able to, after having agreed to borrow at fixed rate of 10% from the original lender, now she has contracted with the Interstate Swap bank to pay LIBOR floating and receive 10% fixed rate. So where she pays 10% to the original lender is cancelled off when she receives 10% from the Interstate Swap bank, IRS bank. And effectively, when she contract to pay LIBOR floating to the IRS bank, that is the effective rate of interest cost for her loan. Paul borrows at floating rate, LIBOR plus 0.5%, but since he prefers fixed, he enters into a swap contract with the IRS bank to pay fixed at 10.10 and receive the floating rate. So the floating rate that he pays to the original lender, LIBOR plus 0.5, is cancelled off, and then he agrees to pay 10.1% fixed to the IRS bank. Remember, first he was quoted fixed rate of 10.75%. All right. So this is a diagram. Paul is here and Mary is here. Paul is here borrowing from his lender at LIBOR plus 0.5. Mary is here borrowing from her original lender at 10% fixed. So as we discussed, Mary contract with the IRS bank to receive 10% fixed and pay LIBOR. So this 10% and this 10% cancels off, and her effective payment is LIBOR for the loan that she borrowed from her lender. Then the Paul borrowed at LIBOR plus 0.5% floating from his lender, from his bank, and then he contracts with the IRS bank to receive LIBOR floating and then pay to the bank at 10.5%. It was 10.1%. 10.1%. Now, look at his cash flow. When he pays LIBOR plus 0.5% to the bank who lent money and receives LIBOR from IRS bank, his effective cost here is 0.5% plus 10.1% paying to the IRS bank. So total cost of 10.6%. 10.6%. Remember, he was quoted originally by his banker that he has to pay 10.75% for his fixed rate. But now he ends up borrowing. He ends up borrowing at 10.6%, 15 basis points lower. Paul pays LIBOR plus 0.5% to the lender and 10.1% to the bank and receives LIBOR from the bank. His net payment is 10.6% fixed. The swap effectively converted his original floating payment to a fixed rate, getting him the most economical rate. Why is that most economical? He was quoted 10.75 and he's ending up at 10.6%. And fixed rate was the rate stream that he preferred. Similarly, Mary pays 10% to the lender and LIBOR to the bank and receives 10% from the bank. Her net payment is LIBOR and at a floating rate. The swap effectively converted her original fixed payment to the desired floating, getting her the most economical rate. The bank takes a cut of 0.1% from what it receives from Paul and pays to Mary. Remember here, Paul pays 10.1% and the bank pays Mary 10%. So there is a margin of 0.1% to the bank, Interstate Swap Bank. So this example shows that how effectively the interest rate advantage could be shared between the two borrowers. Now, in this example, we have showing Interstate Swap Bank separately, other than the lending institution, the bank here and the lending institution here. But even without that, if Paul and Mary are good financial professionals, or if these two parties are two large corporates where CFOs, qualified CFOs are employed, they could structure, effectively, they could structure an interstate swap agreement between them, avoiding the interstate swap bank. So thereby sharing this 0.1% margin to that bank also between those two institutions. So all that depends on the respective sophistication of financial literacy between Paul and Mary, or the two institutions, in their shoes. I guess this explains well. Any question? How do banks make money on swaps? The bank's profit is the difference between the higher fixed rate the bank receives from the customer and the lower fixed rate it pays to the market on its hedge. The bank looks in the wholesale swap market to determine that rate it can pay on a swap to hedge itself. It's to show that there is good money to be made here, and they can effectively be the market makers for the interstate swap market. There is skills and professionalism to be built, accrued, and as time goes by, there'll be many institutions like this, and between themselves also they can trade the interstate swaps whilst facilitating the real economic entities to hedge and then reduce the interest rate commitments in their borrowings or in their investments. In the case of bonds, investment in bonds, fixed rate bonds and floating rate bonds can also be applied this kind of a solution. So imagine this kind of a transaction being arranged by a money broker. You could put yourself in this position, thereby earning a margin. I know that you are not allowed to trade on your own account, but being here, you could ask these two entities to share their interest rate flows independently and pay you the commission from both parties. So that the money broker's role as it is. But what I suggest is that when you have a better understanding and then make representations to the regulator and then make a slight adjustment to the model, ask the regulator to give you the license that enable you to be a stable institution and financial instruments like this for you all to receive payment and also make payment to the other party, keeping a margin. So remember those 2-3 lectures delivered by the two assistant directors of the domestic operation department. Do you remember the questions that I raised with them at the end of it? Whether the regulator would be open to amend the model for money brokers, enabling them to engage in cash flows on their own account. If such an amendment is requested with good reasons, I guess the central bank, the regulator, might consider. Even until then, you could ask these two entities to exchange the interest streams directly and pay you a commission. You will earn commission from both sides. Understood? How do you calculate? Looks like cake, isn't it? How do you calculate the swap? Simple formula: swap rate contract into the interstate differential, brokers markup divided by 100 and multiplied by the price and number of days per year. So, for example, contract is 100,000, interstate differential is 0.75 plus the brokerage 0.25 divided by 100 into price 1.25 and divided by the number of days per year, 365. Answer is 3.42. As per the agreement, 3.42 could be shared between the two parties. If not, the broker can exchange the cash flows and keep the 3.42 for the broker's income. I guess you would have understood the interstate swaps with this example in a clear-cut manner. All right? A contract to exchange two financial liabilities. What is a swap transaction? It's a contract to exchange two financial liabilities. For example, swapping fixed interest rate debt for variable interest rate debt. They are commonly used to enable a borrower to change the basis of interest payments and will often incur a fee. Incur a fee. In this whole process, what you do is you create economic activity, and at the same time, the borrower number one and borrower number two, effectively they reduce their cost, borrowing cost. So naturally, your service as money brokers is really valued here because the cost of production by the borrower one and borrower two both, after having borrowed at a lower interest rates, they are able to price the goods to the final products to the market at a lower rate, and thereby reducing the cost of products bought by the end users, consumers. Isn't this a great achievement? Because of your involvement in arranging an interest rate swap type derivative transaction to help the entrepreneurs borrow at lower cost than they would be borrowing otherwise. And thereby their input cost, financial costs, reduce financial cost, is making their price of goods, final products to the market, lower price. And the consumer who buys their goods pays lesser price for the goods. So all win situation. You earn your brokerage fee, and the end consumer is happy because they can purchase the goods produced by these enterprises who borrowed at lower cost and priced the goods at a lower price. Difference between swap and futures. Now there's another financial derivative called futures, financial futures contract. A swap is a contract made between two parties that agree to swap cash flows on a date set in the future. A futures contract, financial futures contract, obligates a buyer to buy and a seller to sell a specific asset at a specific price to be delivered on a predetermined date. Now, financial futures contracts, I think we'll speak in the next few slides. Financial futures contracts are also a derivative in financial instruments based on an underlying instrument. There can be interstate futures, there can be foreign exchange futures, there can be metal futures, there can be gold futures, there can be treasury bond futures, and various types of futures contracts. Financial futures contracts are essentially traded in an exchange through futures brokers. How are interest rate swaps priced? Interest rate swaps are priced so that on the trade date, both sides of the transaction have equivalent net present values, NPVs. The fixed rate payer is expected to pay the same amount as the floating rate payer over the life of the swap. Given the prevailing rate environment where today's forward curves lies. So all this is explained in that example very well. Okay, I guess you understood very well about the interest rate swaps. The features are simple, and you are going to understand the features better when you run through the example that I have created here. So therefore, I suggest to understand the concept clearly, please go through this worked out example as well and try to simulate the money brokers and the respective borrowers dealing with each other directly, and try to simulate examples and then understand very much better. You can see how conveniently you can make a difference in the market, provided that you receive the support of all stakeholders, including the regulator. And then only you can make the market improve, market grow, expand the market. All right. Futures contracts, financial futures markets. Futures contracts are standardized agreements. Now, standardized, when I say that, you can consider a forward contract. When forward contracts are agreed with bankers, forward foreign exchange contracts, they are over the counter market because bankers structure the terms of the forward foreign exchange contract amount. Any comment? Any question? Please speak up. We are waiting to hear the question, please. Any comment, any question, please? Somebody wanted to speak up. No? Okay. I was comparing the forward foreign exchange market. Now the forward market is always a over-the-counter market, and the bank and the customer, bank and the two banks can decide on the amount and the tenor or the period. But in the financial futures contract, the futures exchange standardize the contract amount and the tenor. Naturally, in the futures exchanges, the amount is fixed something like $1 million or 500,000 pounds. And when one wants to buy one contract, it is $1 million or 500,000 pounds. If someone has the idea to transact in $5 million worth transactions, then if it is in the US dollars or dollar terms, 1 million each, you have to buy or sell 5 contracts for the 5 million. And on the other hand, if someone wants to deal in the sterling pounds, standardized contract amount is $500,000, for example. And if the transaction amount is 450,000 pounds, still he has to buy or sell 1 contract, and the balance amount, 500,000 minus 450,000, has also to be taken into consideration in the cash flow, and that additional 50,000 has to be managed. And when it comes to the tenor, the length of the contract, usually, for example, the futures exchange fixes the tenor, say March 2022 contracts. June 2022 contracts, September 2022 contract, December 2022 contract, like that. In that particular March, June, September, or December month, a specific date is chosen, say last Wednesday of the month, as the settlement date. So by that date, whoever bought March 2022 contracts has to take delivery of the underlying instrument on the third Wednesday of March 2022 and pay the price or the money equivalent as consideration. All right. On the other hand, if someone has sold March 2022 contracts on the third Wednesday of March, they have to deliver that amount of underlying commodity on the third Wednesday of March 2022. And they will receive the money equivalent into their bank account through the futures broker. And the futures brokers, unlike the shares market or stock market brokers, they charge, they ask the trader, the person who buys or sells the futures contracts, to pay a margin before buying a futures contract or before selling a futures contract. 5%, 10%, or 15%, as the futures exchange decides, the margin amount has to be paid to the futures broker, and the margin account is maintained in the name of the trader who bought or sold futures contract, because if the price of the futures contract moves against, then that margin funds are required to be maintained to liquidate the position, and recover the loss from the margin funds. However, futures broker will inform the trader who bought the futures contract or sold the futures contract that your position is out of the money, you are incurring a mark-to-market loss, and periodically he will want top-up margin to be placed in the margin account so that the futures broker does not have to forcefully unwind the transactions if it's a bought contract to sell, if it's a sold contract to buy, and to cover the position when it goes against. But when the futures purchase contract or sale contract the price moves in favor, the mark-to-market profit is always applied to the margin account and subject to a minimum percentage of the margin funds to be maintained. The balance money could be taken out. So therefore, thereafter, the sales proceeds or the profit that are accruing in the margin account could be taken out by the margin futures trader, and therefore futures contracts are essentially used by speculative traders very much to speculate and then earn additional profits. So standardized agreements, only variable is going to be the price. To buy futures contract or to sell futures contract. It can be a specific commodity of futures. It can be wheat futures. It can be crude oil futures. It can be gold futures and any commodity. Or it can be exchange US dollars for sterling pounds, euros. Or it can be treasury bonds or US bonds or UK gilts at a specified time in the future. At a specified time in the future, I explained that usually futures exchanges decide on the future time, March contract, June contract, September contract, December contract, like that, at a specified place. Say, supposing if we establish a futures exchange in Sri Lanka, in Colombo, or in the port city Colombo, then the specified place is that port city in Colombo. At a price established, at the price agreed through open outcry or electronic trading. Now, increasingly, most of the exchanges are being converted to electronic trading in a central regulated marketplace. The futures market, like in the case of Colombo Stock Exchange, they are regulated highly. The Colombo Stock Exchange are regulated by SEC and then also by the CSE. So therefore, futures exchanges are also regulated by the regulators to ensure smooth functioning. The two key components of a futures contract are standard quantity of a strictly specified good or currency. Therefore, the price becomes the only variable. Transactions are facilitated by futures brokers. Financial futures contracts are a contract to deliver or to take delivery of a financial instrument at a certain date in the future. Example I have cited here is the bills that are accepted by banks, BAB, bank accepted bills. Now, for example, in Australia and few other countries, developed markets, when there is economic trading place in various goods, the seller issues an invoice with the sale to the buyer, and the buyer accepts the invoice, and that becomes an accepted invoice or accepted bill. Then usually the seller is paid after some time, say 30 days, 60 days, 90 days period. So therefore, seller collects those accepted invoices and takes them to his banker, and banker accepts them, and in most cases, more often, a percentage of something like 90%, 95% of the total value of the bill or invoice, accepted bills, are credited to the customer seller's account. And the bank will receive the full face value after 30 days or 60 days or 90 days. Those are established markets. And these bank accepted invoices or banks accepted bills thereafter become securitized paper. And a bundle of them can be sold to prospective investors. And on top of that, those banks accepted bill securitized paper, there are futures contracts on that. Say, apart from the bank accepted bills market, cash market, another futures contract also has evolved. Contract to deliver or take delivery of a, shall we say, 500,000 Aussie dollars, bank accepted bill on a specified future date. So all those bank accepted bills which are maturing up to March 2022 can be bundled and sold in the cash market. At the same time, then March futures contracts of these BABs also can be another market, which will depend on the cash market bank accepted bill market, the price. Say every 100 is sold at 95, or every 100 is sold at 94, 90, or 98. So naturally, when you converge toward the March third Wednesday, March closing or settlement date, the discount on 95 or 98 will come towards 100, converge towards the face value. In some cases, delivery may be difficult due to the nature of the financial instrument, the underlying instrument which forms the basis of the contract. Say, supposing crude oil futures, when they trade crude oil futures, unless you are a petroleum dealer purchasing crude oil for the futures market, futures contracts, and then on a settlement date, closer to settlement date, for you to take delivery of the crude oil, you should have the required tankers or the ships that carry the crude oil, or stores that can store the crude oil, all that. So therefore, it becomes difficult, or due to the nature of the financial instrument, the financial instrument is the futures contract. So therefore, most of these futures contracts, if someone has bought, if it is for March, third Wednesday in March 2022, towards March 2022, before that date, they sell off. Or if you have sold it, you buy the contract, the market, and then cover your position so that it sets off your liability to deliver or to take delivery, where the crude oil storage can be avoided when you cover your positions with the opposite contract. And also due to regulatory constraint, there can be difficulty in delivery. So what you do is the financial futures contract, if you are sold, you buy equal amount, or if you are bought, you sell an equal amount. And then the physical delivery is avoided. Main financial futures contracts traded in the Sydney Futures Exchange are 90-day bank accepted bills, 3 and 10-year Commonwealth government bonds, all ordinary share price index, 30-day interbank cash rates. When you are speaking of Sydney Futures Exchange, the main financial futures contracts traded are, we have mentioned few there. How trading is reported? You have to always go through a futures broker. Naturally, futures brokers are sophisticated. They will give you a dedicated link to conduct your trading, and they will want you to open a margin account with them and send in the initial margin. And in the process of trading, if any positions mark-to-market loss is going to be accrued to the margin account, then there will be notice sent to you to top up the margin and then bring back the margin level to the required percentage of the market value of the product that you are trading in. So how settlement is affected is that apart from the initial margin and the top-up margin, all the sale proceeds of such futures contracts are credited to that margin account, and purchase consideration is debited to that account. So with the movement of futures price, you make profits or losses, and they accrue to the account, margin account maintained by you with the futures broker. And they send you daily statements of the position of the margin funds that are held with them. So this enables the smooth operation of futures market. And the most important thing is that futures market prices move in parallel to the cash market or that particular underlying commodity or the financial instrument. And one has to study the price movements of both markets to take advantage of futures markets. So next product is options. I hope you understood both interstate swaps and the futures market as financial derivatives. Option contracts, okay, we have one live example in Sri Lanka with Ceylon Petroleum Corporation hedging their crude oil imports. Option contracts are also an agreement between two parties. Option contracts can be over-the-counter contracts as well as exchange-traded contracts as well. There are option exchanges established in developed markets. An agreement between two parties. One grants the other the right but not the obligation. When you compare with the forward foreign exchange contracts, forward foreign exchange contract, both parties, the customer and the bank, or between two banks, both have the right to deliver and right to take delivery. There is nothing you can forego once you enter into an agreement. But in the option contracts, the seller will give the buyer the right to buy or sell, but the buyer, after having bought the right to buy or sell, will have the option of no obligation, meaning the buyer may decide to not to fulfill the contract, buying or selling. That's why he said one party, the seller, grants the other party, buyer, the right but not the obligation to buy or sell. If the seller grants the right to buy to the buyer, it is a call option contract. If the seller grants the right to sell to the buyer, it's a put option contract. An instrument under certain conditions. The instrument may be a stock, a bond, a futures contract, interest rate, or foreign currency. Now we discussed the futures contract. There can be options on the futures contract as well. So there's a derivative on the derivative. A derivative on the derivative. Or there can be an option contract, shall we say, on John Keel shares. John Keel shares, someone, option seller can agree to sell option contract to buy John Keel shares at 100 rupees. So if the market price of John Keel shares is above 100 rupees on the strike date, on the contractual date, then the option buyer will, under the option contract, will have the right to buy the John Keel share from the seller at 100 rupees when the market is 150 rupees. So that there is a profit margin of 50 rupees for the buyer. But having bought the right to buy the John Keel share or the call option or the John Keel share at 100 rupees, if the market price is 80, the buyer who bought the call option contract on the John Keel shares will not buy John Keel shares at 100 rupees from the option seller, but instead will go to the market and buy at 80. However, when the option buyer bought the right to buy or the call option from the seller, the buyer has to pay a premium payment to the seller, and the seller, after having receiving the premium, has to stand ready to sell the John Kill share as prescribed by the call option contract and bought by the buyer when he decides to buy the John Kill share from the seller. Similarly, a bond, and similarly a futures contract, and similarly an interest rate, and similarly a foreign exchange currency, foreign currency, US dollars, sterling pounds, euros, Japanese yen. So these are the option contracts. It can be the opposite also. Opposite is right to sell, but no obligation. Seller can sell a put option to the buyer of the option contract that gives right to sell John Kill shares at 110 rupees to the seller. So the buyer of the put option of John Kill shares will exercise the put option contract to sell at 110 only if the John Kill share market price is below 110. If it is John Kill share market price is above 110, he will forget the put option contract and sell it to the market at 115, 120, 125, 130. So the option buyer's expense is only the premium paid to the seller. But on the part of the seller, the only income is the premium received. However, option sellers, being market makers, they cover their positions with other option market makers. Whatever they are bought, call options, put options, they cover their positions with others in the market, option market, and cover their risk. And essentially they make this business a speculative trading place and then make profits. The buyer pays a premium for the privilege of right to buy or sell an instrument at a predetermined price known as the exercise price or the strike price. Last date the contract may be exercised is known as the expiration or maturity date. Last date the contract may be exercised is known as the expiration or maturity date. Here we describe the CPC oil hedging contract. 6 features uniquely describe an option contract. Rules for exercising the contract. If it is American style, can be delivered at any time up to the maturity date. if it is a European style, can it be delivered only at the expiration or the maturity date? So therefore, there is more wide flexibility on the American style. Until the maturity date, they can buy or sell. But in the case of European style, it's only on the maturity date. Only on the maturity date, the buyer can buy or sell. Type of contract. Call options gives the right to buy to the buyer. Put options gives the right to sell to the buyer. But there's no obligation. They can forego the contract, thereby the premium paid is a cost to them, cost to the buyer. The underlying instrument is normally specified. The expiration or maturity date is also established. The exercise of strike price is agreed. The exchange at which the contract is traded is also known and agreed. So CPC oil hedging contract is also an option, a call option contract. Advantages on use of option contracts. Highly geared with only a limited amount of capital at risk, the premium paid. The capital at risk is only the premium paid. Can be extensively used to limit the overall risks associated with holding a portfolio. Can be extensively used to limit the overall risk associated with the holding a portfolio. It's a good hedging instrument. Transaction costs will generally be lower than those for trading in the underlying physical market, physical instrument. Can be sold short when the underlying asset has not yet been purchased, which may not be permitted on the underlying asset. So in short, you understand, I think, very well. Without having the financial instrument or the commodity, you sell, you agree to sell. So you can sell through option contracts. So best strategy is that you sell, and then when the price drops, you buy back that particular option contract and make that difference as a profit. Pricing and trading, complex process on pricing. Pricing is the calculation of the premium to be applied to option contracts. So complex mathematical formulas used. So therefore, usually computer programs are employed to calculate the premium. Then trading and hedges treat the premium as an insurance premium to protect against upward price risk using call option, downward price risk using put option. So the premium paid is considered as an insurance premium. When you buy a call option with that established strike price or decided price, when the price is moved up, is a good hedge. As long as the price goes up, you have always the right to buy at the agreed rate, which is lower, and then you cover your upward price risk at a profit. So similarly, downward price risks with the premium paid for using put options, you have the right to exercise the put option strike price by selling at that rate when the market prices are lower. So it's a hedge against downward price risk. CPC oil hedging contracts, call option bought at $120 per barrel, and the premium paid on that call option was to be covered by another sale of put option at the rate of $85 per barrel. So to set off the premium paid on call option contract, to make it zero cost, the put option at strike price of 85 was sold. Crude oil prices rose up to $145 per barrel initially, then declined to $30 per barrel. So the call option at a strike price of 120 become useless when the price is lower. But the put option that this CPC sold at $85 per barrel stands very valid. The buyers of the put option made a huge profit by exercising the put option at $85 per barrel, which they finally bought at $30 per barrel. So that close to about $55 profit were made by the 5 bankers who supported CPC. What we have to learn here is that a complex derivative like option contracts, when employed to cover the oil imports, there should have been sound financial advice and explanation of the risk aspect of the put option being sold. Because if you plot the risk on an option buying and option selling, as we discussed before, when you buy an option, you pay the premium, and that is the total loss. But you stand to gain as long as the price improves, and the gain is unlimited or infinite. But when you sell an option, you earn a premium. That's the only profit that you earn. But you have to stand ready to deliver or accommodate the trade as long as the price moves. Now, it is a good example. When the put option was sold by the CPC at $85 strike price, when the price dropped to $30, it could have dropped to zero. So the loss potential in selling an option contract is infinite, whereas the profit element is limited to the premium earned only. So unfortunately, CPC lost a colossal amount of money having entered into the oil hedging contracts with the 5 banks who supported CPC to in this option contracts hedging business. Buyer of an option contract taking a long position is also known as the holder. Seller taking a short position and is also known as the writer. So the holder has a limited loss and then unlimited profits, whereas the seller or the writer has a limited gain of the premium and the infinite loss possibility. The holder pays the premium to the writer upfront. The writer faces the potential liabilities later. Profit or loss of the writer is the opposite of that of the holder. Profit or loss of the writer or the seller is opposite of that of the holder or the buyer. Holder has 3 basic strategies, alternatives at the maturity of the contract. Holder or the buyer has 3 basic strategies. 1, exercise the option and buy or sell the underlying commodity. That is when the market prices are moved in his favor. Allow the option to lapse and do nothing except lose the premium. That is when the market price is against, moved against. Like in the case of all option contract, $120 per barrel, when it moved against to drop to $30, CPC just ignored the contract. But had it remained above 120, above $120 per barrel, then CPC could have imported dollars at the market price and claim the difference between the market price and $120 from the banks. Holder pays the premium to the writer upfront. The buyer pays the premium to the seller upfront. Writer faces the potential liability later. Profit or loss of the writer is the opposite of that of the holder. So the 3 basic strategies what we discuss is that exercise the option and buy or sell the underlying commodity and make that profit. Allow the option to lapse and do nothing except lose the premium. That is when the market have moved against the buyer. Offset or cancel the option by taking the counter or opposite position of opposite portion with the same features to recover the premium paid. Now the CPC could have managed also the sale of put option at $85 per barrel by buying a put option when the crude oil prices are dropping. They could have taken sound financial advice and bought a put option contract at a closer price to 85, and thereafter close this contract. If that had happened, that supposedly that huge loss wouldn't have materialized. That is the third strategy that is mentioned here. Why manage risk? Assets and liabilities are mismatched. Accrual accounting does not capture all risks. So this is going to be a different subject. I manage risk. Since we are almost touching the timeline, we shall discuss from there here onwards tomorrow at 4 p.m. So what do you think of the financial derivatives market? Are they rocket science? Are they difficult to understand? Or do you think that such products can be introduced in the Sri Lankan market? Skill-wise and knowledge-wise and ability to handle operationally, I don't think Sri Lankans are worse off. Sri Lankans can do it, but someone has to initiate and lead the projects and establish such instruments into our market and introduce them. So therefore, please understand these derivatives financial instruments and do your research part, understand them, and then engage in a group discussion, seek the advice of professionals and your seniors. Let's think that in the near future, we are able to introduce at least few of such financial derivatives into our market. The benefits are going to be, one, your increased revenue as money brokers. Two, development of the financial market. Three, the benefits that are going to accrue to the financial entities and through them to the general consumer, general society. So, and finally, with the increased efforts, one day we can see Colombo or Sri Lanka as a emerging financial hub All right. So please let me know a date on the next week on which you can discuss your assignments online with me, and then to enable me to give you additional or appropriate marks on the assignment. All right. I won't ask whether there are any questions on whether there are any questions on the financial derivatives that we discussed, because I know that you'll are very reluctant to ask questions. Okay, so let's meet up tomorrow at 4 p.m. Good night.
Good night, sir. Good night.
Good
Sir.
night. Good night. Menaka?